Today we're talking about the big beautiful bill, what that's likely to cost, how that cost could change over the next 10 years, and what are the implications for investors.
There are more than $5 trillion worth of tax cuts in the House's version of the big beautiful bill. This has got to be stimulative for the US economy, right?
Most likely not. $4 trillion of that $5 trillion is just extending the 2017 tax cuts, which the market and the economy are going to feel as the absence of a tax hike as opposed to a new tax cut.
If you take into account the projected impact from tariff collections and federal job cuts, combined with the House's version of the big beautiful bill, it appears to be deficit neutral. So ho-hum for the bond market, right?
Even though this bill could be budget neutral over the 10-year budget period when you include tariffs, the Treasury still has a funding gap and they need to rebuild their checking account at the Federal Reserve, both of which could push up bond yields in calendar Q4 and beyond.
Hello and welcome to the Deep Dive by STRAT. Today we are diving into the big beautiful bill, or at least the House's version of it. Just in terms of where we stand today, the House recently passed their version of the bill. Now it goes over to the Senate for them to create their own version, and then we need to reconcile those two versions. The stated goal by the administration is July 4th. We think that's a bit aggressive, maybe a bit unreasonable, but let's dive in to the House's version. Headline, kind of narrative reaction is this is a big fiscal boost. This is something that's going to be very exciting for the economy, very exciting for stock markets, but we're here to take a deeper look. So what is going on with this bill? How should investors be thinking about this bill?
The reason why it's called the big beautiful bill is because there's a lot in it. You have extension of tax cuts, you have new tax cuts, you have new spending, you have cuts to spending, and then there are a couple things that are significant that cannot be included in the bill due to how the budgetary process works. We're going to touch on those as well. So what are we talking about? The first biggest ticket item that's going to increase the fiscal deficit by roughly $4 trillion over the 10-year budget window we're talking about is just extension of the 2017 tax cuts. How stimulative is that going to be to the economy? Not stimulative at all, because it's an extension of a tax cut. We view this not as fresh fiscal stimulus. Investors aren't looking at it that way either. We're viewing it as the avoidance of a tax increase, which is different, okay? Everybody was expecting that to happen, but that's our starting point on our beautiful waterfall chart. Then we have expansion of the 2017 tax cuts, things like enhanced child care tax credit, no income tax on tips, overtime, things like that. Those are worth about $1 trillion. Key thing here, those are only set to be in effect through 2028. So they, right now, are not slated to last over the entire 10-year budget period. 4 years worth of new tax cuts. And then you have some new spending on things like border and defense. And in total, the blue items here that would increase the deficit from that baseline, total $5.3 trillion. All right? Then we start cutting, or at least the House does. You start with repealing a lot of the Inflation Reduction Act green tax credits, eliminating student loan relief, cuts to the SNAP program, tighter Medicaid, other reductions. That brings us from 5.3 trillion expansion of the deficit to something like 2.8 trillion over the next 10 years. That 2.8 trillion number is what you're going to see quoted most broadly by the CBO, by anybody who scores the bill. That sort of follows the budgetary rules that you're going to see, all right? Then you have two other big ticket items that are not included in the bill. One is tariff revenue. So you have to make some assumptions here if tariffs going to be part of the arithmetic. If you assume that tariffs as they're currently in effect today, something like a 13 percentage point average effective tariff rate, stays in effect for the entire 10-year budget period, and you make some assumptions around, fewer imports, fewer exports because the tariffs we enact are reciprocated, things like that, that should be worth about $2 trillion in revenue for the U.S. government. That's your biggest revenue boost. So that shrinks the fiscal deficit. And then you also have lower federal employment through two things. One, the DOGE cuts that have already happened largely. And then two, the federal hiring freeze. Those things together, if they continue over the 10-year time period, the hiring freeze part, that's worth about $300 billion. So we did it. We made our way back to zero.
It's magic. It just all works out.
It's magic. It's all gone.
And so you listed a lot of assumptions there.
Yeah.
Right? There's a lot of uncertainty that still remains despite the relatively standard process of pricing this out over a 10-year time horizon. That's going to be really difficult to do. And so some of the things we're thinking about, we call them the biggest swing factors, the biggest uncertainties remaining with regards to this bill and this fiscal policy. The first being, as we mentioned at the top, the U.S. Senate is going to want to get their hands on this bill and have their influence over this policy. Yep. What's that potentially going to look like?
If they push back on some of those spending cuts, particularly around Medicaid and those Inflation Reduction Act green credits, and you water down those cuts, then this increases the fiscal deficit more potentially. So we're on the lookout for that. And then also the Senate has the wherewithal to make this a bigger bill.
Yep.
So go bigger on the tax cut side, go lighter on the spending cut side. So by the time the Senate's done with this, it could increase the deficit by an estimated, $1 trillion more than what the House passed.
Yeah. Could be even bigger, and some would say even more beautiful when it comes out of the Senate, right?
Yep.
The other uncertainty, you noted the expansion of the Tax Cuts Act from 2017. Those only are in effect through 2028.
Yep.
Important to note, we have congressional elections in 2026. This will be right before the 2028 presidential and congressional elections. Pretty hard to get elected as a congressperson if you don't vote to extend tax cuts, right? You're effectively voting to approve a tax increase.
Right, and nobody wants to do that. That's why typically what happens here is these types of things are going to get extended. If they get extended beyond 2028, add another $1 trillion to the deficit from what we showed on the prior slide.
Yeah, exactly. And then most interesting lately in the news, we're filming the day after the U.S. Trade Court made a ruling saying that the Trump administration's tariffs were unconstitutional, essentially. He overused his Emergency Act powers. A lot of assumptions going into place for how long these tariffs are going to be in place, how big they're going to be. That's obviously a huge uncertainty here.
Absolutely. And when you look at the math on the prior slide, though, you see that tariffs have to be part of the equation if we're going to get into any reasonable budget situation over the next 4 years or the next 10 years. So that's why we think the Trump administration is not just going to let these tariffs die because of that International Trade Court ruling. They have other legal avenues that they can use to enact pretty much the exact same tariffs. And so we think the tariff revenue number, it's going to be a significant thing for at least the next 4 years, as long as President Trump is in office. After that, these things could be walked back if there's a new administration. But if you looked at the math on the prior slide, you need tariff revenue to make it work. Walking back the tariffs completely, the math, it doesn't add up.
That's half of your revenue offset, right?
Exactly. So they're going to find a way to raise tax revenue through tariffs.
Speaking of legal challenges, right? We've already seen some challenges in court for the DOGE job cuts, right? So it remains to be seen, are those going to stay in place? And then the other aspect of that is who's to say next election, new party in power, make up for lost time, and increase hiring significantly, right?
Yep, exactly. And then you look at just listing those 4 giant swing factors, what's probably about the same size, if not bigger than all of them, is interest costs. How is the bond market going to view all of this and the sustainability of this fiscal situation? Because if Treasury yields start rising, if the bond vigilantes come out and start trying to instill fiscal discipline on the U.S. government, interest costs are going to go up.
Yeah.
And that's a pretty big risk factor. Yeah.
In taking that biggest swing factor into account, right, interest costs, that's something that Congress or the president doesn't have direct control over. You're not going to tax policy that number away. The outstanding debt is too high. The interest rates are high as well. And just looking at those relative levels, I mean, the net interest expense is as big as the primary deficit, right?
Right. Now we're looking at the fiscal deficit as a percent of GDP, and we show out into the forecast horizon some of these swing factors. We're trying to give the viewers an idea of how, one, significant the interest cost is, the red bar. It's bigger than all the other bars out into the forecast horizon. So that's the biggest swing factor. And then 2, if you look at two different scenarios, one scenario is those new tax cuts that are set to expire in 2028. If those are just allowed to expire and you include tariff revenue, in that situation, you can see the budget is basically neutral. So if you see somebody talking about how this is going to be budget neutral, that's probably what they're talking about. But then if you say those new tax cuts that are set to expire in 2028, let's assume those are extended, and you take out the tariff revenue, we get on, once again, a pretty ugly trajectory. And we think the risks here are tilted towards larger fiscal deficits than what's estimated here because of that swing factor from interest on the debt.
Yeah, and we'll be diving into that in the last minute in terms of the timing of potential drags or expansions from this big, beautiful bill. And so if or when this bill gets passed, that's going to have implications for how the Treasury conducts business, which in turn will have implications for interest rates along the yield curve, right?
Yep. So let's talk about timing. So you said July 4th to pass the bill seems unreasonable. Before the August congressional recess, which starts on August 2nd, seems a bit more reasonable, and that lines up really well with the Treasury's estimate of the X date, or the day that the Treasury runs out of money. So if they lift the debt ceiling as part of the big, beautiful bill, and it goes into effect on August 2nd, what's going to happen, near term, long term? First thing is, the Treasury right now, because the debt ceiling is in effect, they can't issue net new debt.
Right.
So how are they funding government operations, paying bills, et cetera? They're drawing down their checking account at the Federal Reserve. They're using their checking account, right? That's called the Treasury General Account. In normal times, that should have about $850 billion in it. Because they're drawing it down right now, you can see the big drawdown before tax time. And then, they've built it up because of tax receipts. But over the next couple months, they're probably going to get that back down to the $250 billion range. And when that debt ceiling is lifted, then they have to rebuild that checking account at the Treasury. That means they need to issue new debt pretty much right away. And if they're going to be issuing new debt, how are they going to do that? You can issue Treasury bills, you could issue notes, you could issue bonds. So bills are short term, notes and bonds are longer term. You have to be very thoughtful about that so you don't scare the market and issue, for example, too many 10-year notes, and then the 10-year yield goes up, and that can spook markets and make things more difficult. So what are they going to do? And we think the answer is it's not going to be so much Treasury bills.
Right.
The reason for that is they like to keep the amount of Treasury bills as a percent of government debt outstanding around 20%. That's a risk mitigation strategy. Treasury bills are short term. If you have 1/5 of your entire debt maturing in a year or less, that creates a lot of refinancing risk. They're already at 21%. They've been over that 20% threshold since 2023. So they're probably not going to be rebuilding the Treasury General Account by issuing a ton of bills. They're going to have to issue longer term stuff. And when they start issuing longer term stuff, you mix that with all these dynamics, plus you throw in things like the Moody downgrade. We think that's probably going to bias U.S. Treasury yields, long-term U.S. Treasury yields, bias them higher as we get into September, October, Q4, calendar Q4. So that situation, obviously we know what that does to the bond market. That's difficult for the bond market. It's probably great if you're a pension. Your liabilities could go down there, but also the equity market might not like that either. You would think, we passed this big tax cut bill, tax cut extension, the equity market should rejoice. One, the biggest component was already priced in.
Right.
Two, there are a lot of swing factors here that could mean this balloons the deficit in an unsustainable fashion. Three, if it sends up long-term Treasury yields, the equity market's not going to like that. So managing risk around this bill is extremely important if you're a portfolio manager.
Absolutely.
Yeah.
So a lot more information to come. It'll be a big summer for the big, beautiful bill, and we'll keep you all updated as appropriate. But that will do it for this edition of the Deep Dive. If you have any questions or comments, please feel free to reach out.